and our next panel will be on new models for financing renewables. The panel will be moderated by Professor Bruce Usher, and Professor Usher is the Faculty Director of the Social Enterprise Program at Columbia Business School, where he teaches MBA students on the intersection of finance, social and environmental issues. He is also the chairman of Persistent Energy Partners and was the CEO of Securities Group, which he led through an IPO, a secondary public placement and strategic investment, and the sale of the entire company to JP Morgan. The panel will further consist of Kevin Parker, Stephen Viscovich, Jimmy Chuang, Amy Grace. Now join me in welcoming our panelists and the moderator.
Thank you, Paul, for the introduction. Renewable energy, as you know, is all about capital. What I really mean by that, it's all about investing capital effectively and efficiently. And today's panel is here to discuss new models for financing the sector. And I've asked each of them to begin with no more than 5 minutes each, addressing a different area of new renewable energy financing. After that, I have some specific questions. I'd like to address them, and then we'll open up to questions from all of you. Before we get started, allow me just to make 2 minutes of comment just to open up the panel. Investment in renewable energy in 2012 totaled $244 billion globally. This is up from $100 billion in 2006, before the financial crisis. It's the only sector globally where investment has gained substantially through the financial crisis and beyond. Almost every other industry has suffered in the meantime. That's the good news. The bad news is that renewable energy, excluding hydro, makes up less than 5% of energy production in the world today. The vast majority of energy produced today is from fossil fuels. We are nowhere close to slowing, let alone stopping, climate change. And the greatest challenge of our time, and especially for the students in the audience, the greatest challenge of your time is likely to be climate change. Yet our politicians are feckless, our international negotiators are hopeless, and at the annual climate change conference taking place in Warsaw this week, things have gotten to the point where so little progress is being made that environmental groups earlier today actually staged a mass walkout. So where does that leave us? Surprisingly, I'm very optimistic. Not because of any expectations that politicians and governments will get their act together, but simply because renewable energy is now cheap enough, now efficient enough, now reliable enough to compete with fossil fuels in many places. And because capital is moving in that direction. But mobilizing capital, mobilizing the billions, hundreds of billions of dollars of capital at the scale needed to halt climate change requires innovation from our finance professionals. And so here we are today with this panel to address that very issue. So I'm going to ask Jimmy to kick us off, give us just a few minutes background on work they're doing at SolarCity, particularly in relation to the issue of tax equity. Jimmy, over to you.
Sure. Hi, my name is Jimmy Chuang. I'm with SolarCity. As some of you might not know who we are, SolarCity is the largest distributed generation solar company in the country today. We sell clean energy to our customer and cheaper. Basically, the customer, they can sign PPA or lease with us, put no money down, but they can save money on day one. So our goal really, SolarCity, what we try to do is really try to change the country, hopefully the world, how people think about using energy, right? We'll try to become on-site generation on the power and also become self-sustainable. And we want to do that by install solar panel at every house, every home. That's really our goal. And my role at the SolarCity, I'm the head of structured finance at the SolarCity. My team responsible for raising tax equity, like Bruce mentioned earlier, debt, and also securitization. right? Which Steve will talk a lot more later on. And it's been a very exciting time, right? So 2 days ago, we just closed the securitization. That's the first time in the business. And also that's investment grade asset, right? So that's really telling the industry, not every solar asset is investment grade, but if you do everything right, you could produce investment grade asset and you can attract a lot more investor, a lot more capital coming into our business. So in terms of tax equity, how many of you are familiar with tax equity at all? Do you know what I'm, because when I was graduating from school, I had no idea what a tax equity was. And I never thought I was going to build my career around such unique investor class. So basically, tax equity been around for 40 years, 40, 50 years, coming from affordable housing, historic credit, and it's been almost single most important incentive for renewable, right? And this is 30% investment tax credit. Basically, if a project costs you $100 million, that's utility scale, or 30,000 at a home, right? The home system. That's a 30% investment tax credit plus another accelerated depreciation maker, right? So the two things roughly finance 50% of the system cost. And remaining cash flow we can finance through debt, through tax equity, now through securitization. So that's how we finance kind of solar system historically for the past, I've been doing this for 8 years now, right? For the past 8 years, really that's what we've been doing and raising money, which is been very important to our business. And I think some of you know, in 2016, the 30% ITC will drop to 10%, right? So think about before they financed roughly 50% of solar system. Now they will only finance 30%, 10% investment tax credit, plus the NPV 20% depreciation. So what we have to do is really drive down this. First of all, we should try to get more extension on the investment tax credit. I think hopefully at some point we will get better guidance on that. So, but then as industry, we just have to drive down the system cost and also drive down the financing cost. So even at the 2016, when ITC dropped to 10%, we can still have a lot of capital, more efficient priced money, we can finance the deal. And solar has been a tremendous growth, right? It's a $100 billion market, and we are double our growth every year, right? So we are hiring 250 people per month right now, 250 people. We have around 4,000 employees today. When I joined 9 months ago, we were 2,500 employees, right? So and we will continue to see the same growth for many years to come. We are the largest one in the business right now in the residential and the commercial, but our penetration rate is barely 0.1% in the business. And even we double the growth every year, by the time we get to 1 million customers, which will be 3 to 4 years from now, 20% Duke Energy, the customers they have, will only get to 2.5% penetration of the market. So what do we have to do to do as much as we can, hire as many people as possible to do the work. So it's been a very exciting time. And I've been doing solar for 8 years now. I'm at SolarCity. Before that, I was running financing at another publicly traded company called GCL. Before that, I was in a similar capacity at a company now it's part of Edison. So very excited to be here today.
Thank you, Jimmy.
Great. Steve Viscovich. I'm a director in the Securitized Products Group at Credit Suisse, focusing on what we affectionately call the esoteric asset class, which of course includes many renewable energy assets. I'm responsible for building out our renewable energy securitization platform, and it's great to be following Jimmy, because when you think about the evolution of products and financing, securitization sort of follows tax equity in terms of when it's able to enter into a market. I guess a similar question that Jimmy asked, how many people are familiar with the ABS marketplace? Right, so big picture, we effectively look for predictable, consistent cash flows to be able to pool those into a portfolio and then issue bonds off of those cash flows and assets. Simple as that, right? A lot of what we rely on is historical data. So part of the challenge that you see in securitization these days is that there's not that much historical data for renewable energy assets. So Jimmy pointed something out which was truly groundbreaking. We closed it this week. It is the first ever securitization of distributed generation solar assets. you probably read about in some of the papers out there, but Jimmy's team and the Credit Suisse team, we were able to get that done. And it's just, in grand comparison to other securitization deals, it's small, right? It was only about $54 million. But the reason it's gotten so much press, the reason it's gotten so much publicity is because it is a huge breakthrough for that industry and the renewable energy industry in general. A lot of what you read in today's article, there's an interesting article out actually, and a lot of what you read about it is some of the biggest advances in renewable energy are not necessarily going to be technological. There certainly will be, but a lot of them are going to be financial. Well, what kind of innovation is going to be there? Well, it's going to be providing access to more efficient, more scalable capital to be able to finance, truly hyper-growth industries that will change the energy landscape. If you think about securitization, you've probably heard of stranded asset deals, right? A lot of utilities, when they deregulated energy, the utility industry in various states, there were basically sunk costs and investments, right? Energy utility companies will invest in a project, expect a 30-year payback, and as soon as deregulation occurred, you had a lot of these assets that were not going to be able to get paid back. Well, what ended up happening was the regulators allowed them to assess a fee on everyone in the rate-paying base. And how is that fee able to, compensate utilities? Well, we do stranded asset securitizations. So this is just sort of the next evolution to be able to finance businesses like SolarCity, other renewable energy assets. And like I said, it's something that is truly groundbreaking. It's an asset class that we believe that will be one of the largest in the market. Typically, you talk about ABS, you hear about mortgages, auto loans, student loans, credit cards. Clearly there are a plethora of other assets get done, but don't get the visibility that this $54 million deal did. And I think it's because people realize, the public realizes that this is a groundbreaking opportunity for such a growing industry to have access to very efficient, very scalable capital, and it's all based on the creditworthiness and the consistency and predictability of the cash flow. So clearly we look at distributed generation solar, energy efficiency loans. You see a lot of project finance deals out there for large power plants, for large solar farms. It's something that I think will help to build out what will be a more diversified energy landscape and something that I think we'll all benefit from.
Hi, my name is Amy Grace. I am a wind analyst at Bloomberg New Energy Finance. I cover North and South America. Bloomberg New Energy Finance, which is now owned by Bloomberg, basically provides data and a lot of research on the clean energy and carbon markets. I think when we talk about financing and the innovation of financing, it's usually typically trying to address one or both of two issues. And one is reducing the cost of capital to drive down system costs generally, and the other one is access to capital. When you think about the utility scale market in wind and solar in the US, there's no need, there's no dearth of financing available for utility scale projects. So if you have a wind farm or a solar farm that's utility scale and you have a PPA, which is very important, you can find financing for that. That's not a problem. I think development financing is another issue, and there is a lack of development capital or financing for development. But where these publicly traded vehicles, which I'm about to discuss, come into play is really to reduce the cost of capital. And there's been 4 of them recently that have either been actively pursued or actually done. And those 4 are master limited partnerships, or MLPs. They're currently not available to renewable energy. It requires a legislative change, so an act of Congress has to happen in order to make MLPs available for renewable energy. Christopher Coons, who is a senator from Delaware, introduced the MLP Parity Act, which would expand master limited partnerships to the renewable energy industry. It's sort of been growing in traction, but it's definitely not anywhere close to passing. Master limited partnerships are mostly available now, or exclusively available for the natural gas industries and other depletable resources, so for pipelines and things like that. Part of the reason why they've gained a lot of traction, I think, is basically because it's very easy in Congress to say, well, let's level the playing field. It's a subsidy that exists for the fossil industry. It should exist for renewable energy. A lot of the OEA in particular, I think, which is the wind industry lobbying group, and a lot of the other sort of proponents of renewable energy have been quiet on it, mostly because they're afraid that if you expand MLPs for the renewable energy industry, it puts into threat, or there's a threat that they'll lose the production tax credits, which are the main source of support for the industry. And frankly, if you remove the production tax credits or the investment tax credits and substitute that with MLPs, the economics don't work. The industry relies very much on those tax credits. So one of the other problem with MLPs is that they don't work with tax credits. They don't work with tax equity. So they would really be used for an exit MLP, or what they call. So after the tax credits wear off, after, in the case of wind, the year 10, when you no longer receive production tax credits, you can roll into an MLP. I think, interestingly, some of the support for MLPs expanding to renewables has come from an unlikely source, which is the natural gas and industry and sort of the traditional MLP investor. And one of the funny reasons for that is that they're worried that MLPs will be taken away from them. So they say, well, let's level the playing field, let's make them available for renewable energy. So I think that's sort of the unexpected sort of cheerleader for MLPs for renewables. Another one is REITs, and those are the real estate investment trusts. Those are slightly different. They require also another change to make them available for renewable energy, but it's not an act of Congress. It's a regulatory change. So basically, it's an IRS ruling, which is somewhat simpler if you've been watching anything that's happening in Congress recently than an act of a congressional legislative change. So that they basically have to say that the REITs, which are currently available for real estate, can be expanded to include solar and wind and other renewable energy assets. The reason that this is tricky, it's complex for a couple of reasons, which I won't get into too much detail. But more or less, if you change and say that a solar farm or a wind farm, those what's now considered equipment, is now actually real estate, it also puts into question whether or not they can actually get some of the tax credits. There's also problems melding those with the tax equity as well. So currently, MLPs and REITs are not available to the renewable energy industry. They both require a change, but there's a lot of talk about making them available. And also, if it actually ever were available, there's problems integrating that with the existing tax credits. The third one is the Foreign Asset Income Trusts, FAITs in Canada. Those are basically a Canadian REIT that is available to Canadian owners of exclusively foreign assets. Threshold Power most recently tried to roll some assets into a FAIT and IPO that in Canada, and that was a colossal failure. And then finally, yieldcos. And yieldcos, facing real yieldcos, are currently available to renewable energy industry. Yieldcos are probably the most sort of accessible right now and the most interesting. Energy Yield was a recent IPO on the yieldcos. The problem with yieldcos, even though they are accessible to renewable energy right now, is that with the case of NRG, it was a portion of the portfolio that was renewable energy, and then the rest of it was fossil. And they were monetizing their own tax credits. So again, all of these structures have problems with the tax equity investor. Should I leave it there? No.
That's terrific.
Okay.
Great start. Kevin.
Hi, I'm Kevin Parker. I've been involved with sustainability for a while. I remember speaking at the Investor Network Against Climate Risk in 2006 at the United Nations. And there were 6 people in the room listening to me speak. I was the only one on the panel, and one of the people in the audience was my wife. Now, I look to my left here, and I've gone from the only speaker on the panel to the oldest speaker on the panel by a fair margin in 6 years, which is really encouraging, frankly. One of the benefits of being 20 years older than all the other panelists is that I've had time to do a few things, a few more things than you guys. And So just to recount some of the things I've done in my career, I've been on Wall Street for 30 years. I'm an organic and biodynamic farmer. We're winemakers. I founded and built the largest biogas, biomethane company in Europe today, so a full-fledged renewable energy business. I've lectured, I've authored over 40 papers on climate change and regulation and sustainability, and I currently run a firm in sustainable investments. So I was asked to talk about regulation, and particularly carbon tax and carbon regulation. I had an idea a few years ago to invent what was called a carbon counter. I don't know if anybody's ever come across it, but in association with MIT, we actually produce a real-time number of the metric tons of carbon dioxide and other greenhouse gases in the atmosphere, and worked a lot with Columbia, with Jeff Sachs and Michael Girard, working on following and tracking the regulations in the world. And it's been really encouraging. If you look at the regulatory environment over the last 10 years, it really looks like a beautiful 45-degree angle of increasing regulations around carbon, encouraging the development of renewables and so forth. And so much of what you're hearing about the growth in renewables is really due to, in part, the regulatory environment that's been created, which is still woefully inadequate for really addressing the problem, and the 5% out of the total 100% of energy produced in the world being renewable is clearly needs to be a lot higher and go a lot faster. But in places like Germany, where regulation has really encouraged the development of renewables, those numbers really approach 30% or 35% of total energy output. So the regulatory environment is critical, but it's been maddening and frustrating for any of us that have been involved in talking to the regulators anywhere in the world, whether it be in Copenhagen or wherever the UN meetings are being held. I stopped going because I've just got so frustrating listening to people talk about doing a lot of nothing. But the one regulation I think is missing, and is really an egregious omission on the part of regulators and politicians worldwide, is a tax on carbon. And really that's the only thing that I think puts fossils on a level playing field immediately, and is really going to be the Kickstarter for accelerating renewables to garner a much greater share of the energy footprint. Certain markets have started, like in Europe years ago, the carbon markets, but those have been fraught with lots of problems about lack of transparency, about the size of the market, the supply, when the supply is coming on, and so on and so forth. And really no one's come up with the right formula here to really address this issue. But the carbon counter tells us that tons of greenhouse gases are being emitted at a rate of 800 metric tons a second. When I started the counter, the number was 378 in terms of parts per million. It's now at 402. And just a show of hands, how many of you are under 30 years old? Yeah, most of the folks here. So if you're under 30 years old and you're planning on having kids, at the rate of growth of carbon in the atmosphere, probably most of your kids have a pretty good shot of seeing the end of the human race. So I really urge you to get out there on the regulatory side and call your congressional leaders and so forth, and make them aware that we need a price on carbon. Thank you.
Kevin's tempering my optimism that we began with. Stephen, so Credit Suisse launched the first securitization of solar assets just this week, which is terrific advancement in the field. Let's talk about wind for a second, and wind versus solar. Is there potential for securitizing wind assets? What are the differences between wind and solar when you think about securitization?
Sure. I think I mean, certainly there have been project finance deals that have been done in wind, and certainly I think it's possible to do securitization for wind assets. I think the challenge relative to solar is just the predictability and the consistency of the resource. Clearly you can go and get analysis done and figure out what the probability that there's a certain amount of resource that comes in from wind versus solar, but that variability is great in wind. Solar, it's much more predictable. The variability is not as great. And in the securitized markets, really that's what we're looking for, right? Consistent predictability. And if you don't have all of the data, using something along those lines would be pretty difficult. So I would never say it's not something that can't be done. It's certainly a more difficult task, and I think one that people, as we continue to build out renewable energy securitization, as we look at distributed generation solar, we'll look at wind, we'll look at all sorts of other types of renewable energy, and I think over time you'll certainly see some of those asset portfolios being financed.
While we're on the subject of wind, Amy, offshore wind. Are we ever going to see offshore wind off these shores?
So yes is the answer to that. Whether or not it's Cape Wind is the first, I think, is the big question. So when I said before that access to financing is not a problem for wind in the US, I was not talking about offshore wind. Cape Wind has a big problem in that they are now looking for what should be about $2.6 billion in financing. Of that, the trickiest part is sort of the equity combination. They'll probably get the debt. It's easier for them to get the debt. With a investment tax credit, about $780 million, you need about $1 billion in tax equity. There's never been tax equity deployed into the offshore space. Typically, tax equity investors are really risk averse. I haven't spoken to anyone, some certainly would not comment, but I haven't spoken to anyone that was gung-ho behind investing tax equity into the Cape Wind project. Also, $1 billion, last year, in a record year for wind build, I might add, the entire market for tax equity is about $6 billion. So this is 1/6 of the market for tax equity going to one project. So it's a huge amount of tax equity. But I also think the real challenge for Cape Wind in particular is the equity component. When you look at a lot of the offshore projects in Europe, the first offshore projects in Europe, they were financed by large utilities on balance sheet. So they were utilities that were building the project for themselves, for their own rate base, and they were building them on balance sheet. There's never, Jim Gordon can't do that. He doesn't have the capital to do that. He has to seek third-party equity. The project that has been permitted with a relatively older version of Siemens turbines that has kind of capped the equity upside for the project. And so you're not looking at a particularly great equity return, and I think that's really the ultimate challenge for Cape Wind. So I think finding financing for offshore is a huge problem for the US. It's also a big problem for Europe right now. I mean, there's a lot of, you're not seeing much more balance sheet financing of these offshore projects because, frankly, they just can't afford to do it. But I think it's in particular a problem for Cape Wind, just because of the way the project's been permitted and all the legal issues around it.
Thank you. Switch gears here a bit and talk about the unexpected. When you think about the energy industry, let's go back about 6 years ago when natural gas was trading at $14, and no one sitting up on this panel, certainly I wouldn't have forecast that we'd be down at $4 and the US would be generating an enormous amount of natural gas, becoming the world's leader in the sector. Similarly, in renewables, 6 years ago, the price of solar panels was what, $3, $4, $5 a watt, and today you can buy panels for 65, 70 cents a watt, maybe even lower. So these are really unexpected events in the sector, and very few people could see those coming. So I'm going to ask our panelists to do the impossible and tell us what surprises do you see out there? What could happen? What would you pick as a potential unexpected event next? Who wants to take a stab?
I'll start.
Kim.
Well, we, in 2010, we authored a paper about coal and natural gas. And I was standing on the slopes out in Colorado skiing, and my phone rang, and it was the Washington Post. They asked me to make a quote tell them something interesting about coal. And I said coal was dead man walking. And they printed that, and it ended up in 1,500 newspapers and magazines around the world. And if you look at what's happened with coal over the last 3 years, it really has collapsed, not just because of fracking, which we wrote a paper about and predicted that it was going to lead to the demise of coal, not only for pricing reasons, but also for carbon reasons, which is now starting to happen. And I think we're going to work our way down the continuum of dirty fuels, and it's going to face the same demise, in effect, coal in this country is looking at. Now, a lot of that's going to China and other places, so put the carbon question aside, but just in terms of the prospects for coal in this country, regulation and the wide availability of fracking gas has truly dead man walking. So I think oil's up next, and I think there's two surprises coming with oil. One, I think, is that McKibben's analysis, if you haven't read McKibben's analysis, which has now been followed up by Wall Street firms in terms of verifying what McKibben is saying. I think that's one great surprise that's going to come to the market here in the next 12, 24 months, which is a revaluation of carbon in the ground. And it's significant if the numbers are correct. We're talking 70% of the market cap of companies being represented by carbon assets in the ground, which, owing to my previous statement about your children to be born, those carbon assets will never be burned, and so these companies have no right to be trading at the levels they're trading at. On the one hand. On the other, I think what you're seeing for oil companies is that many of you who are interested in working in renewables may actually end up working for one of the oil companies, because they are going to emerge as the biggest builders of solar power and renewable assets on the planet, bar none, as they shift, as they begin to shift. And if the surprise about their overvaluation in the market based on their carbon assets in the ground happens and begins to occur, you'll start to see that shift sooner. So I think you're going to see Exxon or Chevron or some of the major oils being some of the biggest investors in renewable energies.
Interesting. Other thoughts?
Have you told that to BP? I guess what would be the most impossible thing, sort of long-term support from the U.S. government for renewables? Yeah, that would be a big surprise. No, I think with regards to coal, I mean, it's really interesting. We're shipping a lot of our coal over to Europe right now, and certainly we're going to see, I mean, we've modeled, I think, about 70 gigawatts of coal retirements in the U.S. Most of that, unfortunately, will be met with both slack gas, just from existing gas plants, and then new gas build. I think actually one of the biggest hampers for renewable energy right now in the U.S. is lack of load growth, frankly. You know, there's unbelievably cheap wind deals happening right now in the Midwest because of the production tax credit, and yet you can't get every single utility to sign one, basically because they just don't need the power. So, you know, if we could get some load growth in the U.S., I think that would be a first step.
Yep.
I think unexpected, although it shouldn't be, but it seems like it would be today, is that both major political parties will agree on something, and that renewable energy is good for the United States. They'll disagree on why, right? One side will talk about environmentally friendly, you know, mitigating effects of climate change. The other side will clearly talk about energy independence, energy security. But, you know, as I think we all see here, renewable energy will need to have a place in just sort of the energy landscape going forward. And certainly that'll continue to grow over time. You know, I think as Kevin pointed out, as some of the larger players in the traditional sort of energy sources continue to realize the hold that renewable energy is having, you know, I think there will be more of a political change, at least in what's publicly being spoken. I think privately a lot of that is being acknowledged today, but, you know, clearly as the constituencies change, clearly as the money changes, I think there'll be an agreement on the end result. Again, clearly they'll disagree on the reasons, but I think that's the unexpected.
based on today's environment.
That'll be a wonderful surprise indeed, for all the right reasons. Jimmy, you want to add to that?
Yes, for sure. So I think, so by the way, Chevron has been pretty active in the solar business for a while now, and I would love to see them do a lot more investment, but they have done construction work, they play some tax equity role before on bigger projects, so hopefully we'll see more companies like that to come into play. I think unexpected, right now, how we are using power, right? It's like power are generated far away from us, remotely. I think over time you'll see that change. I talked a little bit in my earlier stuff. I think over time the power will be generated on site, and that could be solar, could be battery storage, can be a combination of both, and that is happening part of the country, and it will continue to grow. And I think 10 years from now, hopefully 10 to 20% will be on site, right? And 30 years from now, I think 50% will be on site. But I think we'll hit a number. You can't be everything put at people's house, right? So it doesn't generate that much power, and maybe technology will change. And you will see a lot of utility come to work with us together, right? So because I have seen a lot of utilities, they want to invest in a space with solar with us now together. Could be at a company level or just as a tax equity investor. And I think they will finally find a way to work with us as well. I think it's not they have to win, we have to lose. I think everybody can win in this business. And I think ITC will get extended. So, I mean, a lot of people think solar will die a long time ago, and that we always survive. And either it will be extended for another few years, or will slow down to go down, like a drop from 30% to 10% over 10 years, but not a cliff, because we are just creating so many jobs right now. The industry is growing, right? So it's great for the country. I don't think we can just cut this from 30% to 10%. That will be very bad for the industry.
It's an interesting forecast on the ITC. Certainly the expectation is it'll drop, but that would be good as well for the industry. So I'm going to ask the panel one more question for all the panelists, and then I'd like to turn over to you, the audience, for any questions. And there are two mics, so feel free to use whichever you wish. So the last question I want to pose to the panelists is one for really the audience personally, which is the issue of careers. And if you could provide a word or two of career advice about your industry, particularly related to financing the industry, where are there opportunities, where would you not go? Any thoughts along those lines? And Kevin, you want to start us off again?
Yeah, I think, I mean, look, if the, if the landscape is 5% renewables and needs to go to 95% renewables, I don't know when it's going to happen, but it's going to happen, then I think the future is really bright for folks getting into this industry now. At the same time, in the broader tech context of sustainability, I think there's an enormous opportunity, and what our firm is saying and what our firm stands for is really much of this repricing of environmental risk around carbon, around fossils and so forth. It's this repricing of risk and this reallocation through the financial markets, which is going to ultimately channel the capital to opportunities in solar and wind. And so that's really the only force big enough on the planet that I know of to affect change on that kind of scale, short of a broad agreement by everybody on a price of carbon. It's going to be the financial markets which really force the hand, and they're going to do that by repricing risk. And so I think whether you're an operator and you're rolling out solar power plants or building offshore wind plants, or whether you're more of a Wall Street, analyst investment type, because this is such a momentous shift from a high carbon world to a low carbon world, there are opportunities all over the place. It really just depends on what your skills are and what gets you excited to get out of bed in the morning.
Am I allowed to say oil and gas?
I
heard someone told me some remarkable statistic that, and God knows where this is from, but 1/6 of all jobs have been created since the end of the financial crisis have been in the oil and gas industry in the U.S., which is extraordinary, even though all the emphasis, I think, on renewable energy has been on the green jobs, unfortunately. Where do I say in the renewable? I mean, I stay away from wind, that's for sure. We've been through a little bit of a bumpy ride, and certainly we don't have any long-term support, so it's going to continue to be a bit of a bumpy ride. Distributed solar, I think you guys are hiring. I think that's probably where to go.
I mean, I would say just from a Wall Street perspective, and I know a lot of times, sort of we get a lot of the darts and arrows thrown at us, but clearly we see the renewable energy sector as one that will continue to grow and where there'll be plenty of opportunity from a career perspective. Energy just in general, I mean, as he was just saying, there's so much to be done there. And I think one of the things that the opportunity that you all have as you look forward in your career, particularly in the energy sector, it's something that everyone uses, right? I mean, we all unfortunately had to live through Sandy and knowing what it's like without electricity and power, and clearly we realize it is a necessity. And one of the things that we talked about when we were doing this deal is you truly do, we all say a lot of things, but you truly do have an opportunity to change the world, right? Whether it's technology, financial, you name it, combine the two, and it really is powerful. I mean, that's something we said through this entire deal. I can't tell you how many times you challenge the status quo. I mean, I think 80 or 90% of Wall Street thought there was no way we were going to get this deal done. And, clearly it requires persistence, it requires dedication, something that I think everyone here has. And, the opportunity is endless just because the amount of usage of energy, the amount of opportunities that are out there, and the amount of jobs that should be created, I think, will create a lot of bright future for people.
Thank you. Jimmy, Amy pointed out you're the one doing the hiring. So,
so
career advice.
Well, yeah, for sure. So I think I was in you guys' shoes. I mean, student maybe 11 years ago, maybe. So my kids were not the end of the human race, don't worry. And I think really, yeah, I hope not. But I really think to find something you love to do, that's very important, right? So you don't feel like you go to work. You don't need to feel like you go to work every day anymore because you really love what you do, you're really passionate. And you don't have to work in a renewable energy business or do anything really you like to do, feel passionate about. Some people like to make a lot of money, that's great. Some people like to change the world, that's awesome, right? So really depending on what they want to do. And like solar is very hard. And so you really be very passionate about what we do, otherwise most rational people will give up, right? I mean, raising tax equity is really, really hard. And securitization is tough, right? And just you are facing so many different challenges, right? So, and we'll try to predict what will happen 10 years from now. I don't know what will happen next year, right? So, but you just have, but that's why it's very exciting because you come to work every day and you don't know what you can take the company or the business where you can go, right? So I think be very passionate about what they want to do, and we are hiring a lot of people. So my team's pretty big. I've give and take 20 people report to me, and we are hiring people on my group right now. So like a business school student or undergrad, and as a company, we are hiring 250 people per month right now. So we will see that continue to grow as we want to double our growth every year, hopefully. So.
You're saying they should just send you their resumes?
No, I think it's the same. Well, and I will forward out to them. They definitely hire a lot more people than we do. So.
Okay, thanks very much. So let's get some questions from the audience. And if you could keep your question quite brief. I was excited to read in the papers this morning that the Senate could actually stop the filibuster. So I think if they can do it, we can keep our questions very short. Over to you.
Okay, thank you. With regard to the distributed energy and the job creation that you're referring to right now, how do you feel about the Champlain Hudson Power Express, which is a 1,000-megawatt cable coming from dams in Canada that's going to connect into Queens? There are comments due on the DOE December 14th. It's a presidential permit like the XL pipeline. There were hearings this week. 22 unions are opposing this. And I don't see any engagement by the renewable energy industries to oppose this. So are you going to participate with the State Department to oppose this importation with the national interest determination, and along with the unions prove that this is not in our national interest and that it displaces our economic issues here?
I can comment on that. I mean, if you look at New York City, there's not a whole lot of roof space to generate the energy that the city needs. So it's going to have to come from somewhere. And there's not a whole lot of space to put a wind farm. So, transmission is horrible. It's a horrible thing. When you read the dockets of the people who are protesting the transmission lines, you really sympathize with, the chaos this creates and the difficulty of the process. But, Quebec has a lot of hydropower, and it's very clean energy. And if it depends on where your alternatives are. It's either sort of transmitting in hydropower or transmitting in wind from the Midwest, or building offshore, which is also very expensive. In the city, we don't really have any good solutions. So.
Well, there's 5,000 megawatts of mapped out solar. That's been online for about 3 years. I'm just, wondering why you're making that statement now.
In just New York City, it's really tough.
Go to the solar map, and you'll see 5,000 megawatts of rooftops in New York City. Thank you.
Thanks for your question. Sir.
So my question is specifically for Jimmy. From the perspective of solar energy demand, looking forward, how would you think is the most effective strategy to identify commercially viable customers?
For commercially viable customer, so are you talking about for residential or for commercial?
Both.
Both. Well, so what we are offering right now, because given the system cost has gone down so much, right? So two things. One is like Bruce mentioned earlier, before it cost $10 or $15 per watt to build a solar system. And now it's cost $3, $4 per watt, depending on commercial, it's $3 to $5 depends, right? So depending on commercial, residential. So costs have gone down so much. So we can offer a customer, every PPA lease we sign, average, we are saving customers 20% at the least, right? 20%, and we offer different product. So every customer can be, if we can save them money, they are a great customer, right? So the only problem is this industry still very nascent. So right now we have a certain FICO score limit, right? Like a 650 FICO score. That's the most investors that will go. And see, the problem is the customer will most likely pay the electricity bill before they pay the mortgage. Because who wants to live in a home has no power? And you cannot keep it beer cold, you cannot do anything, you cannot go internet, right? So you have to pay the power first. And whether we like it or not, we sign a lifetime contract with our utility anyway, right? So, if I want to get power from PG&E, I live in San Francisco, if I have 500 FICO score, I can still get power from PG&E. They will not say, well, your credit not good, I cannot give you power, right? So, but the industry is so nascent right now. The challenge we are facing, we just can't go faster, broader or not. But I think at some point, FICO will not be important to us anymore, right, Steve? For your securitization? He's been pushing us for the FICO.
I think Jimmy makes a great point. I mean, when you look at distributed generation solar or any type of renewable energy, that's supplying to the house, to the location. The way we look at it is it's a substitute energy payment, right? It's an operating expense of the house. So clearly, as markets are developing, financiers are going to take, err on the side of conservatism and want to work off of, the highest credit quality, whether it be, from a residential on the FICO side, whether it be from a rating on the commercial side, but certainly there is precedent out there. You look at it, we always use utility receivables as a good metric of billed versus collected and what the performance could be, right? It really comes down to the value proposition. If SolarCity continues to offer companies and residential host customers a savings on their energy bill, why wouldn't they make that payment, right? And
right.
If you look at your utility receivables, it's a general population, right? It's the entire rate base. There's no FICO scoring involved, so we don't see why that can't, go there in time. I think as you build this, as it becomes more mature, as it becomes more accepted, you'll go down that route. But as with anything, you're always going to start off a little more conservatively, particularly on the financing side.
Right.
I'd be interested to hear the panel discuss the possibility of master limited partnerships being used for solar. Right now they're used just for fossil fuels and a few other things, and potentially whether it could be a boon for this industry. And from Amy, I'd like to hear why she did not bring up the discussion at all about Atlantic Wind Connection and its potential.
Do you want me to hand
Well, Amy, you did touch on the MLPs already. I don't know if you want to just
sure.
make this
So, I'll start with Atlantic Wind Connection. So Atlantic Wind Connection is this transmission project off the coast of the east coast of the U.S., which is backed by Marubeni and Google. I think it makes a lot of sense if you have a bunch of offshore wind projects out there. I think offshore wind in the U.S. has a big problem. The government has done a huge amount of work on permitting and easing the permitting process, which took Cape Wind 12 years to go through, which is just ludicrous. I think what the bigger challenge for offshore wind in the U.S. is getting ratepayers to pay the very high PPA prices for these projects. So in the case of Cape Wind, it's sort of PPAs that start at $180 per megawatt hour and go up from there. Onshore wind in Maine, which is $60 to $90 per megawatt hour, is really also unappetizing. So you're asking people to pay double for that. Certainly, they never have to be at the same cost because offshore wind generates during the day, so it's a different market that you're feeding into. But it's just a very, very costly project. The Atlantic Wind Connection, I think actually, they're basically waiting for PJM to announce that they're going to rate base the project. And the reason that they would is basically because of the arbitrage opportunity between low-cost coal in the south and running it up to the higher price markets in sort of New Jersey and New York. So I think actually, regardless of whether or not the prospects for offshore wind generally in the U.S., I think actually it could be a very interesting first step, provided that PJM decides to rate base the project. That's the only way it will get built.
Let me just comment once on the MLP, which is kind of pretty similar to what we do. Right, when you go to all the conference, people talk about REIT, MLP, and the securitization. Now we got the securitization done. We think about MLP, right? So MLP is, you need to do two changes. One, the Congress needs to make sure solar part of MLP, but also the passive income. I don't think people really, so MLP will be great if we can make that happen because everyone can become tax equity investor. That's awesome, right? But the problem is, it's a passive income rule. If we don't change that, even solar part of MLP, basically you can't use your ordinary income. It's not your stock portfolio to be really, really passive. And given how tax benefit coming so lumpy for solar and finance so much, without changing that passive income rule, even you have MLP, it's not going to work for solar. That would never work for solar. And that would be even harder to do. Right, so that's why MLP is very challenging.
Just on that, it might not work for new build. So if you're trying to finance the building of a project, it wouldn't work because of the tax equity. But what you can use it for is sort of an exit MLP, which is basically rolling off existing assets after the tax equity partner exits the project, and then you can use that capital to recycle into new projects. Granted, you have to have in the U.S. if you didn't have a production tax credit, you wouldn't be recycling that into anything unless you could get a high enough PPA to support the project. But as an exit MLP, it's a little bit of an easier legislative change, and there's opportunity there. It won't support the industry without a tax credit. So the industry is still very reliant on the tax credit.
Because I'm just sort of saying what would really change the business for solar. MLP will change everything. People can make it happen, read, and other things not going to make much move at all.
Hi, I'm Jonathan McClelland. I'm an energy economist. When we think about investments, there's a risk-return trade-off. The higher the risk, the higher the required return. In the US, there's a general preference in renewable support mechanisms to be market-based. And I'm thinking primarily of renewable portfolio standards and the REC-based trading. And yet, that adds a lot of risk. It's very hard to get an SREC contract more than 3 years out into the future. And yet, when you're doing project finance, you want identifiable cash flows to either eliminate or allocate that risk. So, in terms of trying to be efficient in pricing incentives, are we costing ourselves in being inefficient in financing and effectively requiring a higher level of return on renewable projects than would we have if we had more of a flat, fixed incentive structure?
Sure. I think it depends on what type of market you want to finance in. So, in the securitized markets, particularly for a new asset class, you're going to look to what the contractual cash flows are. So, if it's a PPA or a lease, you're going to look to that 20-year term. There are some performance-based incentive contracts that are a little bit longer. There aren't the traditional SREC market where you just sell it at market price over a particular time. You may have forward contracts that are a little bit longer, or just programs in place that are legislatively and PUC approved and funded, where you can finance those. So I think a lot of that risk that you're talking about, where it's more market-based risk, does rely on, is more of an equity risk, and that's how we view it. Clearly, as you have, again, more data over time, again, this is purely the rated securitization markets. Clearly, there's going to be other markets that are able to do it. I think there is an appropriate sort of risk-return profile at this point in time. And clearly, as you have a more liquid market, right, because what's being built in now in securitized products would be, you've got a liquidity premium because there's not, tens of billions of dollars of this paper trading. Clearly, there's a lot of project finance bonds, but those are really relying on one particular rating, right? The off-taker on the large PPA, whereas securitization is really, right, we take all of your contracts and, I'll take the risk that you guys are going to make your energy payments any day of the week. It's, clearly something that is very well understood. So again, as the markets mature, I think they'll be able to monetize some of that riskier product, but until then, I think the risk-return profile seems appropriate, for the contracts that you're looking at.
Yeah, I think this brings up a really important issue, and what Jimmy's talking about in terms of the growth in distributed solar. The analog here, and this is a 10-year-old analysis we did, is really the analog is really the internet and what we broadly speak of today as internet companies. If you look at where that business was 15 years ago, people were building very low-level infrastructure, arguing about languages, domains, ways of moving data around. There really were no standards. And so the industry had to go through this process of figuring out which were the best standards and agreeing to agree on those standards. And over the last 15 years, because it really is only about 15 years that this whole infrastructure, which we all rely on completely today, was really being built at commercial scale. The same thing has to happen in the energy world for the problem to be solved, because thinking that somehow centralized power generation and transferring it 1,000 miles away is going to be the answer to the future energy problem or carbon problem that we have is absurd. So the whole energy world is going to increasingly look like the internet world in terms of the data not being centralized but being distributed, and the problem being solved by being distributed. That gives rise to the need for standards on many levels, and regulation being one of them. And if you compare the US market to the German market, for instance, in terms of feed-in tariffs versus the quagmire that you face here at every level, whether it be RECs or PPAs or all the various things you have to go through to get a project done, none of that exists in the regime in Germany, which we've written about for years and said that is the gold standard for creating the environment and the standards for which renewable energy projects can enter the grid. And so there's a big lesson to be learned from the internet, from Germany, about what standards can do to really accelerating the development. And all what you're talking about just creates these problems and individual negotiations, and it's really just slowing the rollout of the industry down tremendously.
So yes, internet is a very good example. I think I have a better one. Just think about telecom. So we are just like telecom 20 years ago, right? So, and we decentralized the telecom business by everybody using cell phone. So just like a power today, right? And when you think about, if you talk to anyone, I think younger than 10, they probably don't know what a payphone is, right? I don't even see payphone anymore. And solar, DG energy generation will be very similar like that, just like telecom internet.
We have time for one more question. We started a few minutes late, so we'll end a few minutes late. But sir, over to you. A little pressure. You're on the last question of the panel, please.
Hi, my name is Abhijit. I'm studying energy policy at SEPA. Firstly, thank you for all of you to come on campus and give a very great presentation. My question is actually, takes out points from what you said, what Mr. Kevin said, what Mr. Stephen and what also Emmy said, which is the challenges of renewable energy policy in the US. At the same time, you said global energy diversification. And you also said the fact that going further, now we've found that North America in general has got a good endowment of fossil fuel. So do you think that it makes more sense to actually have policies and regulations in place on an international level for the US to actually, instead of exporting fossil fuel and instead of exporting coal and oil and gas, and use it more locally and rather export renewable energy technology and cheap finance? Because we've seen, as you just mentioned, that Germany already has a polished policy market. India and China also have already in place regulatory standards for renewable energy, which have been quite successful with large capacity projects coming up. So do you kind of support a regime where there is no fossil exports from the US, but there's technology export and cheap finance, 2-3% finance, which gives you a minimum of about a double-digit return on investment? So I would like the panel to discuss this.
Well, first of all, let me just say that I find it amazing that you're studying energy policy. I don't know who in this country could even teach that course. So it must be all foreigners that
we're
that
at Columbia, Kevin. We can do that.
I don't know. I lost my train of thought. So I don't know. Maybe somebody else wants to jump in.
Anybody, Amy?
I guess when it comes to manufacturing and exporting of technologies, I don't know. I'm very familiar with the sort of solar and the wind and those assets, and most of the there's just globally too much manufacturing, whether it be in China or the U.S. or Europe, and everyone's looking to export to another market, and there doesn't seem to be any market who wants to take it. So I think in the short term that there are a lot of challenges with exporting those types of technologies, different for solar than from wind. They're actually very, very different assets. Wind, you actually can't import Chinese turbines to the US, really. There's very few developers or financiers who would back a project with a Chinese turbine, whereas it's not the case with solar. But yeah, I'm a little bit lost in my question too. I don't know what else they were supposed to comment on.
Anyone else want to comment on that? Perhaps, and we are out of time, I'll wrap up by saying I think there's a common theme here, which is the issues of policy always draw sort of a sigh and a feeling that we're just not there. But when we talk about business, and we talk about financing, we talk about cost competitive technologies, and we talk about opportunity, both from a career perspective and an investment perspective, there's a lot going on and a lot of interesting things being put forth here. My great appreciation to our panelists. If you join me in thanking them, please, for being here.
Thank you. Thank you.